What I'm about to say sounds extremely logical, yet nobody told me about this when I was learning to trade and losing trades over and over. Trading is all based on probabilities. So I can tell you this is the best fair value gap, but there will still be a probability, a chance that that fair value gap fills. Just a higher probability that it will actually hold. And the higher the probability, the better. Because if we consistently find the highest probability thing to happen in price action, then the odds are literally in our favor to be profitable. That's how I, for example, make my profits, pass a challenge, and that's how other students right here do it as well. We understand probabilities. So how can we make sure that you understand probabilities as well? In 3 steps. First step is going to be arguments. Second step is going to be the top down. Third step and the final step is going to be about the probability. Now, before we dive into the first step, let's understand a bit better what I'm actually talking about. Imagine this. When we open a chart, we are looking at an argument between the bullish side and the bearish side. We are simply the observers of this argument. You could argue that we are the judge. Both sides will give their arguments, and the side with more/better arguments will be the winner. The more convincingly one side wins, the higher the probability is that we are actually going to move into that direction. Okay, so we are some kind of observer, we have a bullish side and a bearish side, and they're giving us arguments. So what are arguments? Arguments are the same as confluences, and a confluence is a sign in price action that is higher probability to do one thing over the other thing. So to give you an example, a bullish fair value gap is a bullish confluence, a bullish argument that we might actually want to continue higher instead of lower. If we understand what kind of arguments we have, then we can get to a trade ID and a bias mechanically, and we can determine if it's worth risking the money on it based on the probability. And that's where the first step comes in, arguments. So in step 1, we need to understand what creates a certain argument. Arguments are created by any PD array, disrespected or respected based on candle signs. Now, for simplicity's sake, we're going to focus on the following 3 PD arrays. Fair value gaps, swing points, swing highs, swing lows, previous candle high, and previous candle low. So before understanding what it means to be disrespected or respected based on candle signs, let's mark out the 3 PD arrays. We have this fair value gap sitting right there. Then we have this swing low sitting right there. We also have this swing high. Before we reach that swing high, we have this previous candle high right there. And we also have this previous candle low and also this fair value gap right there. Now let's first focus on the fair value gaps and remove everything else. Any of these PD arrays can be disrespected or respected. Disrespected means that the PD array is not holding, meaning we are going to move into the opposing direction. Respected means that we are indeed respecting the PD array and we can move in the same direction. Meaning, if we have this fair value gap right there, respecting it means that we can continue lower because it's a bearish fair value gap. Disrespecting this bearish fair value gap means that we can actually look to continue higher instead. So what is the difference between disrespect and respect? Well, you can probably already see it. See how we wick this fair value gap right there and see how we body close above this fair value gap. That's the exact difference. Why? Candle signs is based on a singular candle. And that singular candle right there, if we understand what's happening on the lower time frame, we can know if those PD arrays are getting respected or disrespected. And based on that, we can know what the next few candles actually want to do. So what happens in this candle when we are actually respecting that fair value gap right there? Well, it's a long wick at the top. So if we visually see what happens in a candle, we open up at a level, we go higher right there, creating a top. We continue lower in the same candle. So we went higher and lower right there, meaning that leaves behind that wick. So in that single wick, in that singular candle, what happens on the lower time frame? Well, on the lower time frame, that's going to look like fair value gaps going higher to then fair value gaps going lower. So creating a reversal, respecting that PD array right there. So that daily fair value gap right here on the lower time frame, fair value gaps going higher and then fair value gaps going lower, creating that wick, creating that reversal. And these fair value gaps right here then create that daily candle long wick that we see. Now that's respecting the PD array right there. But if we now look at disrespecting a PD array, so disrespecting this fair value gap, then we mentioned that's a body closure above the fair value gap. Why? Well, it's the opposite of what we saw with that long wick. We are not creating a reversal. Instead, what are we doing? We open up with that candle. We continue higher, but we don't continue lower. We actually just keep on continuing higher. So we still have those lower time frame fair value gaps, but only towards one side. They only continue higher. We never come back down. So if we only get, here on the lower time frame, fair value gaps continuing higher right there, disrespecting that PD ray, which again shows up as that disrespect candle on the daily, that means we can actually look to continue higher instead, since we're not respecting that PD ray. So these two fair value gaps, we can now see when we respect that fair value gap, we can continue lower in the direction of the respect. If we disrespect that fair value gap, we can actually continue in the direction of the disrespect. In this scenario, continue higher right there. Because we understand candle signs. We understand what happens on the lower time frame with the fair value gaps which are seen through a singular candle. So if we now apply this understanding to as well swing points and previous candle highs and previous candle lows, then we see the following right here. This previous candle high right there is not closing above it with that next candle, is getting swept right there to then continue lower. Where this previous candle low right here has a full, very obvious body closure below it, meaning we can continue in that direction right there. And the same applies to these swing highs right there and these swing lows. Body closure below it right there, we can continue lower. Here, we have a wick above that swing high right there, so we're respecting it. We can actually continue lower because that's the direction of the respect. So we understand which PD rays are getting respected and disrespected. And why was this again important to know? Because that creates an argument. A PD ray getting respected is an argument. A PD ray getting disrespected is also an argument. And then we can stack up those arguments in a top-down analysis and we can get to a probability understanding. So that's where step 2 comes in, top-down. So in step 2, those top-down, we're going to stack up arguments right here on Euro US dollar. And we're going to do that by starting on the monthly time frame. We'll go over a previous example right here, which by the way was beforehand, yes, called out in the MMT as well. And afterwards, we'll go over a live example and see how it plays out. Now, when we look at the monthly, again, what can be very useful right here? We can look at swing highs, swing lows, but for the monthly, I mainly want to pay attention to previous candle highs, previous candle lows. So for example, we see this previous candle high right there getting respected currently. That is, at this moment in time, we can add it in the top right, that's a bearish argument. So if we just simply for the monthly look at that argument right there, previous candle high, previous candle low, perfect. We have one bearish argument right now. No bullish argument just yet. On the weekly, what do we see right here? Well, we are respecting this swing high right there. If we also mark out this fair value gap that we saw right there, we were first respecting it, but then afterwards we came back to disrespect it. So we're disrespecting this fair value gap and we are respecting this swing high. One argument right here for the weekly time frame can be weekly respecting swing high, disrespecting fair value gap. Perfect. Another bearish argument added to the list, whilst we still don't have a bullish argument. So now let's drop down into the daily. Then on the daily, we can see we have this swing low right there getting disrespected. Perfect. Another bearish argument. Afterwards, we do see right here that this bullish fair value gap is currently getting disrespected by that up candle. So that could be a bullish argument, right? Well, that bullish argument has a great bearish counter argument. Why? Because if we were truly disrespecting this bullish fair value gap, then the next candle should have been an up candle, created a fair value gap at this moment in time, right? Which does not happen. So as soon as we take away this potential bullish fair value gap, then we have another bearish argument right there. So the bullish argument, we don't need to add it to the list because it's not fully getting disrespected right there because we immediately continue lower again, which is also seen by the higher fair value gap that we have right there and the long wick at the top. That's a sign that we are indeed respecting the overall fair value gap right there and we can still look to continue lower, especially when we also do not create this bullish fair value gap right there. So we are currently just respecting that bearish fair value gap and we are disrespecting this swing low. Daily disrespecting swing low and respecting a bearish fair value gap, meaning we have a good bearish argument again. So if we now go into our last time frame, into the 4-hour time frame, then on the 4-hour, what do we actually see? we have this bullish fair value gap right there, which at this moment in time is fully disrespected. We have this fair value gap right there created. Okay, that's quite interesting because we're not sure yet if that is a high probability to trade off of. Then we have also a very small 4-hour fair value gap right there, which actually got respected right there. Meaning that at this moment in time, the 4-hour, again, there is still no bullish argument to be found. We are only creating bearish arguments again. So another bearish argument for the 4-hour as well. That right there creates then the arguments list. And that's important. Keep that in mind. Then if we now look at Australian dollar, New Zealand dollar as well to compare it. Again, for that top down here on Australian dollar, New Zealand dollar, we are going to start on the monthly time frame again. On the monthly time frame, let's focus on previous candle high, previous candle low. But at this moment in time, in recent price action, we do also have a fair value gap sitting right there. This is a bullish fair value gap, which at this moment in time is not getting respected nor disrespected. So whenever that's the case, don't add it as an argument just yet. Now, what we do see beforehand is that we were respecting this previous candle high right there, but that's the previous candle. Now we are potentially closing below this previous candle low. Again, the monthly candle right there is not closed fully just yet. So we can't make that argument just yet. So here at this moment in time, the monthly doesn't really have any clear argument. Well, on the weekly, we were disrespecting this weekly swing low right there. Whilst disrespecting this weekly swing low, which is a bearish argument, we are also coming into this weekly fair value gap right there, which at this moment in time, we are respecting. So there's a bearish argument at that moment in time, and there's also a bullish argument. Disrespect of the swing low, respect of the fair value gap. Okay, so potentially we can get a more clear idea on the daily time frame. Well, then on the daily time frame, we have this fair value gap right there. We have this recent swing low, which we are disrespecting again. So that is a good bearish argument. This we are not really respecting, not really disrespecting at this moment in time. Then we also have this bullish fair value gap, which we are arguably disrespecting, but not continuing lower at this moment in time. So since we are not following through off of this disrespect of that bullish fair value gap, that also does not create a valid argument, because then we would have already continued lower right there. So this swing low that we are disrespecting on daily time frame, that's the only argument that we have at this moment in time. For the rest, it's a little bit vague. So daily disrespect of a swing low, the only bearish argument. Okay, maybe we can get some more clarity then on the 4-hour time frame. And then on the 4-hour time frame, what do we see? Well, 4-hour fair value gaps were getting respected right there, but also disrespected right there. And afterwards, we have no fair value gaps that were following through. Meaning, we have no fair value gaps that were getting respected to then create new fair value gaps. So at this moment in time, we have both bearish arguments right there because we are respecting that swing high. But at this moment in time, we're also respecting this fair value gap right there. So for the 4-hour, we have both a bullish and a bearish argument. So again, we can very clearly see this is almost the opposite of Euro-US dollar. It's just not that clear. So let's keep the arguments right there in our mind, and then let's move on to step 3. Because how do we now know if a trade from this 4-hour fair value gap is extremely high probability in comparison to the 4-hour fair value gap that we saw on Euro-US dollar? This 4-hour fair value gap. Well, that's simply based on the previous 2 steps. Focus on the arguments, understanding which arguments we have. Then applying those arguments in a top-down analysis as well. Noting down the arguments. When you note down those arguments, again, we are the judge. So we simply have bullish and bearish arguments in a very objective manner. Then afterwards, we can see, okay, we have this amount of bearish arguments and this amount of bullish arguments. So for example, for Euro-US dollar, we had 0 bullish arguments. So any bearish argument that we have already creates 100% probability that we actually want to continue lower. Now, will 100% probability always be an exact 100%? No. But the important thing is to understand that anything above a 90% probability into one direction is high probability. So trading off of this 4-hour fair value gap right here on Euro-US dollar is 100% probability according to the arguments that we just did. So trading off this 4-hour value gap going into the lower time frame to look for your entry is extremely high probability. Where in that 4-hour value gap, if we then go into the 15-minute time frame and we simply wait for a sharp turn, so essentially fair value gap going lower right there, then eventually what do we see? Plays out perfectly right there of that fair value gap. And not because the lower time frame is so high probability. No, the higher time frame right here was already extremely high probability, and that's the important thing. And afterwards, we follow through right there. And now, what arguments do we have currently on euro US dollar? Well, at this moment in time, in a live example, we still have those bearish arguments and still no real bullish arguments. So unless we start creating bullish fair value gaps, disrespecting bearish fair value gaps right there, we can still simply look for lower prices throughout next week. Where if we compare it to Australian dollar, New Zealand dollar right here, trading off of this 4-hour fair value gap right there, that could play out. We could continue higher off of that, yes. But are the probabilities, are the odds in our favor? No. Which pair would we rather risk money on? The higher probability one or the lower probability one? Well, obviously the higher probability one. Because again, the odds then are literally in our favor to be profitable. So taking a good trade, taking a bad trade, that's all our own responsibility if we understand those arguments and how they then stack up probability-wise. And then from that, we can create a percentage and we can have a good understanding of what is high probability. So if you are starting out, focus on trades that have 90% or more probability, because that is extremely high probability. Now, to help you in calculating those percentages, I have completely for free, for the free newsletter, created an Excel sheet where you can fill in the arguments, the bullish arguments, bearish arguments, and it will tell you if it's high probability or low probability. You can go to the link in the description, follow the steps right there, and you will receive that Excel sheet as well. Again, completely for free, no strings attached or anything. All right, perfect. Thank you.